friend of mine told me one time, it doesn't matter where someone lives, you always have to remember that their home is their castle. And we truly believe that.
You have to
Regardless of
treat
what it is or where you're at, we want to be a focal point in that journey, which is the reason for the name. In New Story Lending, we believe that everyone can write their own story and achieve that dream of American homeownership.
Welcome to the Posner Property Perspective. We're here with Shane, who's going to talk to us. He's got a very interesting background, how he got into mortgages. He runs his own company. He's also going to be able to talk to you if you're looking at expanding your own business. He's also going to talk to you how he got involved in real estate and helping people get into their homes, and how home ownership affects not only your financial well-being, but it's your financial legacy and how important it is. And it has been difficult in the last few years, or last like 2 years, for people to get into the housing market. And we're seeing a little bit of opening now. So we'll talk about all that. We'll maybe even discuss what trends we think are coming. Shane, if you want to tell everyone a little bit about your background, that would be great.
That's awesome, Jamie. Thank you so much for your time. Thank you so much for the opportunity to be with you this morning. I look forward to talking with you and learning more about you as well. You come highly recommended, and your background is very similar as well. So I think we're going to have a great conversation today. So to kick it off, my name is Shane Miller. I am the CEO and co-founder of New Story Lending. We are a full-service independent mortgage bank. We are a true lender, so we do have the ability to lend agency direct, as well as correspond, broker, all of the things, right? And we believe that allows us to do more than what some of the other folks in the industry can do. We do have an emphasis on the affordable housing community. My business partner and I, one of the reasons that we started New Story Lending is because both he and I have been in this business for over 20 years now. And over our past 20 plus years each, we've seen a lot. I like to tell people my story starts before the crash in 2008, post-crash, pre-COVID, and now post-COVID. So we've seen a lot of changes in the past 20 plus years in this business. But my personal story is not to talk super long about it, because I know we have a limited amount of time this morning, but it is, I'm the product of a single mom, and I'm very proud of that. My mom is super strong. I learned a lot from her. She's a very hard worker. And I'll tell you, when you're the only guy in the house with a single mom and two younger sisters, it really changes perspective. And because of that, I learned at a very young age how important it was to earn, how important it is to produce, and to produce for those around you and your family and the communities you serve. And
Okay, so what was your first job?
my first job, so at 9 years old, believe it or not, I was 9 years old washing dishes in what we call here in the South, Virginia, a meat and three restaurant. I'm sure you can say,
Yeah.
right? So my grandmother and my grandfather, who was actually my namesake, I changed my name in the seventh grade from Harris to Miller, and that's a whole different story. But I took my maternal grandfather's last name, and he was such a tremendous influence in my life. But he and my grandmother started a meat and three restaurant in Little Liberty, South Carolina. So at the right age of 9 years old, I was able to work in that restaurant as a dishwasher. And then I like to think that I graduated from that to a server, to a cook, to what, and at least in my own mind, was a grill master at the time. So I started at a very, very young age, and have
Now,
worked at.
I think one of the things we don't see as much in today's society is we try to, like, I don't know if we think we shelter our kids, but I also started working at, like, I think it was like 11. I was a gate girl at the community pool, checking in people. My brothers ran the concession stand. We started very early learning that my father had a philosophy: if you want to eat together, you work together. So everyone did. And I think that helps mold us into future leaders, running companies, helping others, lifting them up. You got your experience. I kind of interrupted you to talk about that. Just thought it was an interesting.
No, but I'm glad you did.
Getting back now, how did you and your partners wanted to get into affordable housing, and how did that all come about?
But because it's the communities that we come from, Jeannie. I mean, we live it and we breathe it. We talk about, I mean, look, socioeconomics has no color, it has no race, it has no gender. And it's one of the things that I talk about a lot is I can say this clearly. I'm a white guy from South Carolina, right? But I come from an extremely rural part of South Carolina, and I'm the product of a single mom. My business partner is very similar. He shares a similar background. He's a Hispanic guy. So culturally, we're a little different, but we come from the same communities. And the biggest thing for us is we want to get back to the communities we serve and the communities that have so well served us throughout our lives and our careers. So while we do have an emphasis and focus on affordable housing, we obviously do everything under the sun. And our zip codes here in South Carolina and Virginia or Florida or Georgia, wherever you call it, there's always parts of the community where you have more affordable housing and the jumbo products. And we quite literally do anything in between. So I grew up in a single wide, what we called mobile homes then, right? Now they're manufactured homes.
Manufactured house.
But I grew up in a single wide mobile home before they become manufactured homes. And I've been very blessed in my life and my career. So I've been able to accomplish some things that I'm not necessarily there anymore. But look, a friend of mine told me one time, it doesn't matter where someone lives. You always have to remember that their home is their castle. And we truly believe that. Regardless of what it is or where you're at, we want to be a focal point in that journey, which is the reason for the name. In New Story Lending, we believe that everyone can write their own story and achieve that dream of American homeownership.
Do you do anything in educating the younger buyers and first-time home buyers about home ownership? Because what I find is, I'll say to people, well, I know you qualified for a $350,000 house, but have you looked at what your budget is going to be? And do you take them through that process as well?
We do take them through that process, Jeannie. It's so interesting that you asked that question. I actually spoke at a Rotary event last night, and one of the focal points of my speech was around affordable housing and the pillar of education that consumers don't always get in the industry these days. So yeah, it's something we're proud of. It's something that we try to do with every consumer. Obviously, there are repeat buyers who know this process extremely well, but your first-time home buyers, regardless of age, need the education. And I talk about the education.
That's interesting. You said regardless of age, because I recently had that happen. I was honored to help someone at 60 buy their first home.
Wow.
And it was really an accomplishment for them. And I was very proud to be part of that journey to help them get there. And it was very fulfilling and rewarding because they were able to show they take care of their grandchildren. So what they're going to be able to do for their grandchildren by having a stable home for them is really important, and it's going to affect future generations. So I think a lot of times people think, oh, we're in this for the money and the this and that, but really it's helping people. It's getting people into their home, providing them shelter, because that all generates from the home. Someone's going to do well in school if they can come home to a good home and they don't have to worry, is there a bed for me to sleep in? Is the electric going to be on? Having that stable environment is so important. So we help provide more than just a house. It becomes a home. And when you're working with people and you said, you have repeat customers, so you can not only can you help them, maybe, let's say you did a mortgage for them 2 years ago and the interest rates were close to 7 or 7.5. Now, as rates are coming down, will you help them do a refinance? How does that happen?
Oh, absolutely. Of course. In fact, one of the things that we talked about last night when I was talking to this group, when it turned more into a forum and I was giving questions, is I remember at their peak, and I've talked to folks who are even higher than the number that I'm getting ready to tell you, but at their peak a couple of years ago, I remember locking people in at 8.25.
Yeah.
And it's hard to imagine. It's hard to even think about that now because rates have begun to moderate and come back down. So yeah, we're pushing a really hard refi campaign right now. We're blitzing the markets. In fact, I reviewed and approved some things yesterday that we're getting ready to publish and send out in the market from a refinance perspective. Anybody who's in that 8 handle, 7 handle, even high sixes are great candidates right now for refinancing because rates have begun to come back down to that low to mid 6 range on average, right? I mean, there's always going to be the folks who are in the high fives right now and the mid to moderate sixes, but on average, we're seeing low sixes right now.
And how do you explain to them sometimes if they've been in the mortgage maybe 5 years, that instead of going to another 30, everyone thinks every mortgage has to be 30 years, but that's not true. You could do the different years. Do you ever talk to them about a 15 or a 20 so that, if they've been paying into it for 5 years, they're not losing what they've built up?
All of the above. Yeah, that's a great question. All of the above. So the 30s, the 20s, the 15s, the 10s, the adjustable rate mortgages. We're having all of those conversations right now because, look, I think in the mind of the consumer, rates are often stacked. The
Right.
consumer looks online and they see that so and so has X rate and everybody has the same rate. And that's not true. Every buyer, every borrower is different. Every consumer has their own debt to income, loan to value, credit score, loan amount, loan type. All of those things matter. So I try to educate them, and our sales fleet at New Story does a tremendous job at educating the consumer on all of their best options and what works, and really tailors it to their specific needs. So we are seeing a lot of 30s go to 15s. We're even seeing some adjustable rate mortgages right now begin to come back because at least the chatter in the market is rates will continue coming down. At least that's the forecast and the projection right now. So if that's the case, there are going to be times where some of the adjustable rate stuff or the lower terms, such as the 15s, make more sense.
Explain to someone what an adjustable rate is because we haven't seen it in a while. So they may
Yeah,
not be familiar with that.
yeah, and it's broadest term and its broadest explanation, adjustable rate mortgages have a fixed rate term for a period of time, and they're generally amortized over 360 months. Now, there are exceptions to this rule that I'm telling you, but normally you have, let's just use the example that you have a 5-year term adjustable rate mortgages. So for 5 years, that rate won't change. It's fixed for that term, that period. And then, but after the 5 years, it can adjust. And it can adjust up or down. But the payment is based normally off of a 360-month term. So you have the advantage of generally getting a lower interest rate for a fixed period of 3, 5, 7, 10 years. But the payment is based on a traditional 30-year fixed rate mortgage. So, but then after, what you got to think about is after that initial period, there can be an adjustment period. So you take the buyers or you take the consumers, Jeannie, who are, for instance, they know they're only going to live in this house for 5 years, or they know that rates are going to hopefully come down and they're going to have another opportunity to refinance. There are some instances where those adjustable rate mortgages make sense because for the buyer who's only going to be in that house for 3 years and they get a 3 or 5 year adjustable rate mortgage, well, the idea is they're never going to see the adjustment period anyway.
And it's interesting because now people are staying in homes longer. It used to be people used to move every 7 years. Now it's every 10. So we are seeing a little bit of an adjustment of that. But you have people who know that for their job, they've been told, we're going to put you here. You're going to train here for 3 years. I've done this with some of my corporate relocation. They're like, we're only going to be here for a certain amount of time because their next big jump, they're being trained maybe to go to a director's position, is going to take them somewhere else. So there are times where people know that, you know what, I am only going to be here for a certain amount of time, or maybe they're training for a medical degree or there's just different reasons why. Now that I think about it, it would almost this is just, we talked about investments earlier, but one of the things that I've had some families do is they've bought, when their child was going to college, they bought a house in that college town for their kids to live in. And then it becomes a rental income. One of them has had it now for multiple years, even though their kids has graduated. They've always been able to fill it through the fraternity brothers.
Mm-hmm.
But I wonder if can you do an adjustable rate on a investment property?
Yeah, there are products out there. There are products out there that will allow that on your different property types, primary, second homes investment. There's also some what we call non-QM, and I'm sure you've heard that, Jeannie, and because they're becoming significantly more popular, but non-QM, non-qualified mortgage products like your bank statements, your DSCR loans, your asset depletion, I-10s. There's so many non-QM products now because investors and lenders are recognizing that not everybody fits that perfect box. So I didn't mean to get off on a tangent there, but that was my long way of answering your question that there are all kinds of products out there now that didn't exist in the past.
Well, I'm just thinking like some of the investors, if they bought a house and did an adjustable rate, because they may know they're only going to keep it for, hopefully they're only going to keep it for like 4 years. And once their child's done with school, they're going to want to sell it. So that's just a new thought that came to mind. Like I said, we talked earlier about investors when we were talking privately. So that's just an interesting thought. You had mentioned a little bit about your background. How did you end up in mortgages and real estate?
God, I
God does,
and I
and you know
jokingly,
what?
I
I always
jokingly
say
say
we
that, but
make
I mean,
plans
look,
and God laughs,
yeah, beautifully said. Beautifully said. I have a friend who said that to me for the first time, probably 8, 10 years ago. Was the first time I heard that phrase, and I was like, that's a great point. That's a great phrase. No, I laugh, Jeannie, because I mean, look, I never shy away from my faith. I am shepherd. God shepherds me all the time. But I said that somewhat jokingly because I never intended to get into banking. In my mind, when I was a kid, when I was a younger, dumber kid and didn't really know what I wanted to do with my life, at first I thought that I might want to be in medicine in some capacity, and then law at one point, and then politics, right? Which is why if you ask me what my degrees are, they're all over the place. I had a really good friend and roommate when I was in my teens, my late teens, going through college. And I stumbled across this job. I was leaving a 5 or 6 year stint at the YMCA. I was a young director for the YMCA for about 5 or 6 years. And I left that job when the leadership at the Y was changing over. So I said, look, now's the best transition time ever if I'm going to do anything away from the Y. So I stumbled across this extremely entry level job at a local bank. And when I say entry level, I didn't know this job existed in the banking system until I did it, but I was a greeter. I was a greeter in the first bank that I ever worked with. And I was the guy that sat at the front. You walked in, I greeted you, asking what you need. I went and grabbed you a water or a drink and said, how can we help you? That was my job. And then from there, I advanced in the banking system and still, frankly, didn't really know what I wanted to do inside of banking until about my second or third year. And that's when I moved into mortgage and fell in love with it. I enjoyed the grind. I enjoyed the hustle. I enjoyed the sales aspect. And I really, really enjoyed the social part of mortgage. I tell folks all the time, the mortgage banks and mortgages, the mortgage department in general, is typically the more consumer forward facing sales department of any bank. And I just really loved it. I enjoyed it. And the rest is history, as they say. You know how it is in the real estate industry, Jeannie. When it pulls you in, it's really hard to get out.
And a lot of people don't. My family started in real estate in the 70s. So off and on throughout my life, I've been involved in real estate. Did real estate in Manhattan in the late 80s. Had a blast. I always laugh. I had the opportunity to possibly work with Barbara Corcoran. Had no idea what she was going to become. That was a missed opportunity.
Oh,
And it's just interesting how things happen and evolve in your life. I owned a bridal store with my family for 25 years. When we closed it, I went back into real estate. My brother started flipping homes right around that time. So it all kind of evolves. You never know where life is going to take you. You have to re-involve. And even in real estate now, having a podcast, making changes, how does YouTube, people go now to get educated through podcast, YouTubes. It just amazes me how this has all changed. And so much what we have to do is educate people about mortgages, what it takes to establish their credit. What do you do now? It's interesting. I was thinking of my son who's 25, they do everything on their credit card. Nothing is cash. And I thought, well, how does that affect? It used to be, we used to say to people, you'd only want to use a certain percentage of your credit. But I'm like, they literally, he puts his rent, the electric, all that goes on his credit card. He pays it off every month. But are you finding that's changing? Like, how does that affect, or should people have more credit? How does that affect the mortgage when you're applying for a mortgage, I guess is the question.
Oh goodness. Well, of course, yeah. I mean, so there are many variables that go into that algorithm we call credit. And credit depth, credit usage, age of credit, etc. I mean, there's so many different things, but the general rule, and again, you know, you heard me mention earlier, there's always an exception, but the general rule to revolving credit is no more than 30% of the no more than 30% usage on the total credit limit on that card. That is typically when you're going to see that that credit works for you and not against you. Now, look, it's not going to beat you down if you've used 50% of the limit on a credit card, but it begins to diminish when you get to that range and higher. And it actually has an adverse effect when you get into the 70, 80% range of that usage. Your credit scores begin to drop at that point. So in a perfect world, keep credit cards at 30% or below. That's where you're going to see the most maximized and optimal output for your credit.
So when you talk to millennials and younger people who put everything on their credit card, and are you seeing that that has had an effect, or I'm just curious if you have to advise them to have more credit card, apply for different cards, what do they have to do to help getting prepared to purchase a home? Because like I say, they put everything. It could be their occasional Starbucks. It's going to be, they don't pay cash for anything. And they don't own a checkbook. They don't know what a check is. Don't ask, they say if you want to, throw them off, ask them with Gen Z, ask them to write a check, give them a rotary phone. They're not going to know how to do that. So, how do you help prep some of these younger buyers to get into homes? What do you see credit wise or student loan wise? Because I think a lot of them don't understand how that affects it as well.
Yeah, well, I started laughing because you made me think instantly about a fella that works at New Story, and he's like a little brother to me at this point. He's been with me for about 10 years, and I'm going to call him out. I'm going to call him out by name here. That way, when he sees this, he'll give me a hard time. But Mark Behan is one of those people that we've had to teach how to write a check because he is of that generation
Yeah.
that does not write checks. They don't use checks. Everything is Venmo or Zelle or something electronic. It's some app. So they don't carry cash. They do not write checks. So it's really interesting to hear you say that because I'm sort of on the cusp. I'm part of that generation that still understood cash because we still had to use it a little bit. But I've come up through all of these changes in the financial sector with these apps and checks and no checks and everything else. So I'll tell you this, Jeannie, and this may be a surprising response. I work with buyers of all ages, and we do it used to. And I will tell you that I've been pleasantly surprised for the most part. And look, when I look at the methodology and when I look at my population sample, if you will, and we close a lot of units in the store. So I talk to a lot of folks. It's not so much generational when it comes to credit card usage as it is the person. The reality is that some people are just more disciplined than others. And I've seen a lot of folks in the millennial generation that are actually more savvy with their finances than others. And I think part of that might be is because we begin to see a paradigm shift in this country where we are talking about finances more. I mean, like, look, when you and I came up through school, did you take any finance classes at all? Did they ever teach you how to budget? I didn't. I don't remember taking one class that taught me anything about finance or budgeting until I got to college. So I think that we're doing a better job now at talking about budgeting and financing. So I think a lot of these younger generations that are coming up are going to be exposed to it a little bit more. So I say that just in general, that I'm not finding as much as you would think I would be seeing with the credit card, with using the credit cards.
It's just interesting because like they just use it as revolving, pays it off every month. But
Right.
now I'm thinking, you know what? I used to tell, now I think I may have to recommend pay it off every 2 weeks so you're not using as much because you're paying it off in full anyways. I'm going to.
That's right. Just overall, keep it before the statement hits every month. make sure you're below 30%.
Yeah.
That's the thing. And to your point, I've seen a lot of folks use credit cards, but they do pay on them throughout the month to ensure that they don't maximize.
And what are you seeing? How much are you seeing people putting down? Because a lot of people will come to me and they'll think, oh, I have to have 20%. I'm like, no, you can do 3, you can do 5, you can do 10. Yeah, if you get to 20, you're going to get rid of the PMI. Um, what are you seeing right now as the trend in down payments?
I'm seeing the repeat buyers bring a lot more money to the table because, as you know, probably better than most, they have so much equity in the homes that they're selling. Well, the
Yeah.
homes they bought 5 or 6 years ago are now worth 1.5, 2, sometimes 3 times more than they paid for it, right? So those buyers are able to come to the table and bring a lot more cash. Your first-time home buyers, your folks who are just getting into the buying market, I'm seeing much smaller down payments. We do a lot of going back to the affordable housing community, we do a lot of down payment assistance bond programs where the down payments are provided to consumers. So we have buyers who quite literally bring nothing to the table by way of DPA and 100% financing products, USDA, VA. And then, of course, we have some. I mean, we closed a loan recently, just this past week, that was, I mean, my goodness, I think the buyer put 85%. So we're seeing one extreme to the other. Folks who are bringing nothing and people who are bringing 80, 90% of their sales price to the table.
2 years ago, because so many people were moving to Atlanta, like during COVID and right after, and they were moving from the Northeast and from like California and Texas. All my deals were cash. I felt bad for my loan officers because I'm like, everyone was buying cash. Now it's changed. The first time I went back to do a mortgage, I kind of had to remember how to do certain things. So it was like, wow. But I think people have to know their options and know that you don't have to always put, the 20% down, that there are ways of getting into homes and they can be affordable. And when you've locked into your rate, like with an apartment rental, every year or every 2 years, that's going up. And yes, your property taxes may change, they are gonna change, but your loan is set. So you have that fixed amount. So it makes you be able to budget and plan better.
You are spot on. You're saying exactly what I've heard a couple of my really good investment portfolio folks say. That's exactly the way they explain it, Jeannie. And yeah, I mean, it's rates have not helped us on the mortgage side because you have a
Right.
lot of folks who have paid cash who otherwise would not have paid cash. And I've heard consumers say that. Well, if my rate was 5%, I wouldn't have paid cash. So I think that as rates begin to come down even more, I think you're going to see a lot more cash buyers lean more heavily on finance because
Yes.
their portfolios are performing. So I mean, if they can make 6, 7, 8, 10% on their portfolios and have a 5% interest rate at the end of the day, they're still winning.
I had buyers when the interest rates were like at 3.5, and they were like, they were going to pay all cash. And I'm like, no, like, okay, just put 50% down and I said, that's like almost like free money, don't
It's
get,
free money. Take the
so,
money, right?
um, I don't think we are going to see, I think if we get interest rates into the fives and low fives, that would be great. I don't necessarily ever want to see 3 again because that isn't necessarily a good thing.
You and I are
Um,
on the same page.
so
You and I are saying the same thing. I believe exactly what you're saying. That's a part of my speech yesterday to this group and a lot of young potential buyers in that audience. And that was one of the things that I told them is exactly what you just said. If we have 3% interest rates, 3%, let me clarify, 3% 30-year fixed rate mortgage rates. I mean, I think it's possible that we'll see some adjustable rate stuff in that range, maybe the 10 and 15-year mortgages we'll see there potentially. But if the 30-year fixed rate mortgage is 3%, that means we're not doing well in so many other spaces of the
right.
economy, other veins of the economy, that it is not good overall for them.
I had the privilege of hearing Doug Duncan, who's just retired as the chief economist from Fannie Mae, and he was amazing. And he's talked about that before. Like, we don't really want to see that again. And they were trying to give, predictions of what we see. And I think by the end of 2026, I think things are going to come back. I think we're going to see rates slowly going down. I think this year we'll get at least, hopefully we'll get another cut, and then then into 2026. And hopefully real estate will start coming coming back stronger. This year, they just adjusted the figure that we're going to sell 3.9 million homes across the US. Pre-COVID, we sold 5 million. We need to make housing more affordable, more in people's reach. And we've also going to have to start producing more homes because we have more people. So it'll be interesting to see how things play out over the next 3 years. I think having a home, knowing you've got that stability helps family life, just helps the community, strengthens everybody. Everyone succeeds when homes are being taken care of. So,
Great. Agreed. Well, look, the housing economy, we are nearly one-fifth. We, as in the housing economy, is nearly one-fifth of the U.S. economy. So it's important. It's very important that the housing economy is good, is strong in this country. And I think we're moving in the right direction. I think we're going I think we're going back to the right place. I just hope that it continues in a consistent pace. One of the things that I think is also stymieing borrowers and consumers in our industry is the inconsistency in rates. You know, I mean, like I told you, I locked as high as 8.25 a couple of years ago, but then we were consistently in the sevens for a short period, and then it dropped to the sixes, and then it went back to sevens, and then it came back to six, and then went back to seven. So at that point, I think that you're seeing this, I would imagine, with some of your buyers, it's exhausting not knowing what's going on. So I think some consistency is going to help us too.
I think you mentioned also a little bit earlier on, but you are in how many states? Because you're not just in the South even.
No, we're in 36 states and counting right now. So we're licensed in 36 states. Started building the company in October of 22. We launched in June of 2023. And in that very short period of time, we've grown to being licensed in 36 states and counting. Ultimately, looking to be licensed across the whole country. That's our goal. And we're working very hard to do that.
And is there what areas are you seeing that are still, pretty busy in real estate right now? Is there any areas of the country you're seeing a little bit more activity than another?
I think we're really fortunate in the Southeast, Jeannie. I think that we normally outperform the other subregions across the country for the most part. If you think about how things seem slow here, think about the West and the Midwest. They are much slower than us most of the time. I would tell you that the two that I'm seeing strongest right now are the Southeast and the Northeast, by far. I would say the Southeast in general. I mean, I'm sure you saw the report that the Carolinas are supposed to be numbers 1 and 2, followed by that little Southeast corridor. And then there's some other states on there in the top 10. But I would say the Southeast and the Northeast, in that Virginia, DC, Maryland, that DMV area, we're seeing a lot of strength as well.
Well, I like to say with Georgia and also in the Carolinas, we get such nice weather.
Mm-hmm.
And even when you're looking at the extreme heat that's hitting, out near Nevada and Arizona, and then you look at Georgia and South Carolina, and we're like sitting pretty, like, yeah, this is why I live here.
Well, I never thought that I would see so many Floridians move to the Carolinas and Georgia. I'm seeing so many Floridians move from Florida to Georgia and the Carolinas right now. And it used to be the opposite. Everybody used to go to Florida.
So what I've seen in Georgia, what has happened, a lot of my friends' parents moved to Florida. They retired, either friends that I knew from when I lived in Manhattan or from here in Georgia, and they moved to Florida. Now they're realizing, you know what? We need to be closer to the kids. And because also they've had their insurance and everything has gotten quite expensive down there, had trouble getting, homeowners insurance because of roofs and different things and all the storms they get. They're moving up here. They're moving to Atlanta. I mean, we're getting quite an influx. It's very interesting. Our 55 and older active communities are flourishing. And South Carolina, the same thing. Is it Cary, South Carolina? I think it's Cary or Corey. Because of the C. But I've had a few clients who are moving up there, and it's really nice, and they love it there. So we are benefiting from, I guess, some people not wanting to be in that heat all the time, and then just that our housing is still affordable compared to other areas.
That's a fact. That's a fact. And you get a lot of bang for your buck here. We're surrounded by beautiful lakes and mountains, and it doesn't take too long to get to the coast. If you want to be closer to the ocean, you can do that. But our insurance premiums aren't quite as bad either. I've talked to a lot of Floridians that one of their primary drivers for moving, frankly, is affordability because their homeowners insurance is as high as their mortgage in Florida because of all the inclement weather.
So if we were going to sum up, is there anything you'd like to share with the audience that they are thinking about buying a home, what they need to start to do to start being prepared? And then we'll have information of how they can contact your company below. But what would be last bit of advice for them?
My advice would be to continue being resolute in your endeavor to purchase and to get into the housing and to get into the market, to create that generational wealth through the American dream of homeownership. And I think the way to do that is to start here. Folks, I think too often wait until they're ready to buy before they get started. And in reality, you don't necessarily know where you stand unless you start early. So be proactive, be diligent, be disciplined. Start now. Talk to a great mortgage lender, preferably New Story Lending, and give us a call and look, fill out that application. Let us give you a free of charge, no obligation assessment of where you stand. And if you're ready today, that's awesome. But if you're not ready today, we can help you get ready so you can purchase in the future.
And that's something important. The first phone call is to Shane's because you got to get approved and you got to see where you are. And like I said earlier, even if you were approved for a certain amount, that doesn't mean you have to spend up to that amount. You know, figure out where you're comfortable, but you don't know what you're going to get approved for if you don't make the call, or you don't know what you have to approve in your credit until you make that call. So the first step is getting a relationship going with your mortgage officer, because they'll be your long-term friend.
That's a fact.
Yep. Well, Shane, thank you for joining me. And as I like to say, we'll see you at the closing table.
You got it. Thank you for your time.
Thank you.
Thanks for tuning into the Posner Property Perspective. I hope you enjoyed today's episode and found it helpful as you navigate your real estate journey. Remember, whether you're buying, selling, or just exploring the market, I'm here to help to make the process smooth, exciting, and stress-free. Let's take the next step together. Contact me today. I'd love to hear from you and make your real estate wishes come true.